Good afternoon, everyone. Welcome to our monthly webinar. We have a great topic here. Probably everybody's very much interested to. For me, living in the Bay Area, I would say two things are for sure. I call them traffic and taxes, the T's. Um, we're actually excited this afternoon to have our guest speaker for today is Shaik that from Sabre Wealth Private Wealth Management. Actually, and then the topic for today will be about top strategies really to offset, income as well as capital gain. It's really interesting presentation. Came across. We met actually at a local seminar in Dallas, actually, and it was definitely very fascinating. I thought it'd be worthwhile for everybody to kind of watch here and say a little background about Zach. He's a trusted stellar advisor, reputation in a lot of the private high wealth net worth. He's been recognized in New Jersey, several wealth awards. He definitely manages a lot of high net worth individuals, 5 to 100 million plus. And his expertise and his business is really around tax, succession planning, philanthropic. He does a whole lot of stuff more. I don't want to take any of his pride, but before we dive into that, like always, we just like to keep our lawyers happy. Again, just a legal disclaimer, Bluestone and BFI, are not affiliated with the presenter or an endorsing of the speaker. A lot of it is their opinion and their own expertise in their domain. This is not a legal or tax advice. It's really intended for, educational purposes. But with no further ado, I would like to introduce Zach. So Zach, I'm going to stop sharing on my side. Welcome to our webinar. Really excited to have you here.
Well, thank you. Thank you. It's my pleasure to be here, and it really is exciting. So let's begin to focus on advanced tax planning to mitigate income, capital gains, and estate taxes and zero out your tax liability, not only for today, but for up to 10 generations or 1,000 years that we can plan for today. And let's redirect your income taxable and capital gains taxable dollars into your own community so that you can build your microcosm the way you see fit. So the two main problems facing the affluent today are the oppressive tax laws and choosing the most qualified advisors. So of course, bigger government, and many challenges that the high net worth income earners are facing. Some of the new proposed additionally oppressive tax laws are on your screen now, where the estate taxes are expected to go up to 55%. Capital gains taxes, dividend taxes supposed to go up to 39.6%. And the annual gift tax and estate exemption is expected to be reduced down to 3.5 million from the current 11.7 million. So let's focus on the various types of income that, for those of you who are W-2, today is your lucky day, because we have certain strategies that previously have not been most likely shared with you. And for those of you working for very large organizations and companies, you, in addition to your salary, also get paid in restricted stock units, ISOs, NSOs, and perhaps for those of you who may be business owners, may also have some ESOP plans in place. So forget about all the other, language that's on the screen and just look at the stuff that's in red, and that's all that we're going to focus on today. So moving along, as you can see with the restricted stock units, they're taxed as ordinary income, as most of you already experience for yourselves. And of course, you get taxed on the capital gain if you held it, after the vesting period. So once again, the theme that repeats itself is that it's being taxed as ordinary income at issue, and then capital gains after being vested. And some of the strategies that you would see that accountants and tax attorneys would propose are here at the bottom, where they may talk about an 83B election, or selling your shares to cover the tax liability, donating your shares, or perhaps doing what's called a net unrealized appreciation transfer into an IRA, which once again does not give you the flexibility and the liquidity that you may want. So we are going to address those problems. What happened here? Okay, here we go. Then there are these additional, again, almost negligible impact on your tax bracket. Recommendations are made by other advisors to open up a traditional IRA, contribute more to your 401k, HSAs, FSAs, charitable contributions, on and on it goes. But as you can see in the writing in red, how limited your tax benefit really is. And not to mention, it triggers AMT. If you look to your far right, all of these types of contributions and deductions can also trigger AMT, which is the alternative minimum tax, and may defeat the original purpose. So just running along employer-based plans that some of you may have through your current employers, and what are the annual contribution limitations on each one of them. And then again, this is for your business owner type person, what these are. Again, if you look at the red text here, you will see how those limitations are being imposed and how difficult it is to take advantage. Then I'm sure you all have been approached by the oil and gas industry tax deduction potential presentation, and the risks that are associated with those are highlighted in red. Continuing on, additional renewable energy type tax credits, electric vehicles, so on and so forth, but those are here also. Not to leave behind the real estate strategies, which happens to be several pages long. And as you can see, accountants may suggest, maker's depreciation, which is basically bonus depreciation, cost segregation strategies, 1031 exchanges, real estate professional status that is very, I see it very often, and very loose advice being given where people are recommended that their spouses become the real estate professional when the spouse perhaps is a stay-at-home mom, and they cannot quantify the amount of hours, which is 1,500 hours a year, to qualify as a real estate professional. And when the audit comes, all of that comes to haunt you. Again, bonus depreciation, it's a short-term solution to a long-term problem. Charitable remainder trust, which is again a very common strategy suggested, but in my 32 years of doing this, I have found that many people aren't exactly charitably inclined, but they're forced to become charitably inclined because the advisor is only aware of charitable remainder trust. So today we are going to switch that. Continuing on, other types of deductions and tax credits and all this confusion that's out there. So let's get into the meat and potato of today's presentation about how the W-2 earners, the 1099 and the K-1 earners, and what particular tax codes they can take advantage of to essentially mitigate their income tax bracket. Okay. So for those of you who are receiving RSUs or any kind of stock option opportunity, we take advantage of the Tax Cuts and Jobs Act and eliminate your income tax in the year that those stock units are given to you. So now it comes inside of this tax bubble and grows tax deferred right out of the gate without inadvertently increasing your income tax bracket. And as you can see on the screen, same thing can be done for the employee stock option owners or sellers that year. So the little known zero income tax strategy for W-2 earners utilizing the Tax Cuts and Jobs Act of 2017. So if you look to your left, you'll see the W-2 income plus your RSU income, ISOs, NSO, And this is your taxable income after all standard deductions have been taken. So we utilize the Tax Cuts and Jobs Act. We open up actually a brokerage account at Equity Trust Brokerage Company, and any or all taxable income contributed zero out income and capital gains taxes. So in other words, whatever income you had made, whatever portion or all of it, if you were to contribute into this account, and the next screen explains it a little bit better, you get to mitigate your income taxes or capital gains taxes while earning a declared 8%. We don't like to say the word guaranteed, but it pretty much is guaranteed 8% return on those funds. This is again for W-2 people, and the distributions are taxed at capital gains tax rate unless additional planning is done. So this is how the numbers shake out. If you had a $300,000 total income between your W-2 and your stock options, $240,000 offset is provided by utilizing the Tax Cuts and Jobs Act, which in this particular tax credit strategy, it pays out an 8% declared rate, and you get $24,000 a year, which can be paid monthly at a rate of $2,000 a month. So this has been a huge lifesaver for a lot of our W-2 earners who have even high six-figure, seven-figure incomes, and sometimes eight-figure incomes after we add up all their corporate benefits and taxable impact on their income. For business owners, and those of you who are real estate investors who receive a K-1, or maybe are independent contractors who receive a 1099, let's get into a strategy that we call a private 401k plan. This is how you can fund millions of dollars into your particular private 401k plan. Up to actually $40 million can be put into it. So here's a little bit of a grid based on your age, how much the initial contributions can look like. But like I said, you can quadruple all the numbers to the right that you see on a first year to mitigate your income tax bracket, okay? And those taxes that you save on the monies that were contributed or captured into these particular plans can help you pay for other expenses that you may have. We have a lot of physician clients, a lot of cardiovascular surgeons, neurosurgeons who pay those tax saved from the income tax as premium into their malpractice insurance. Basically, the dollars get reutilized for different purposes. Here's a quick little summary of additional advanced tax strategies that we can deploy to help you retire literally in less than a year to a maximum of 5 years, regardless of your income right now. So you don't have to wait till age 62 or 65 to retire. And to us, retirement simply means that we're able to replace your earned monthly income by utilizing these strategies, so you can literally stop working at your current job if you didn't like it that much, and then do some other things with your life that you may have wanted to do once you quote unquote retired. So we would love to show you how we can help you retire literally today, in a week, in a month, 6 months, less than a year, with a maximum of 5 years. So let's also touch on capital gains taxes. Most of you are basically only familiar with 1031 exchange or a deferred sales trust, or that's also called a Delaware statutory trust. And these are not the strategies that we recommend just because they're quite onerous, and the deferred sales trust actually is under scrutiny by the IRS over the past several years due to the risks that it presents. So for those of you who may have a DST, please give us a call. We'd love to tell you and show you some alternatives to that. But aside from the 3 not recommended strategies, we have 12 additional strategies. And depending on the attributes and the type of asset you may be selling, it could be real estate, it could be personal property, such as sale of your business, cryptocurrency. We had done a deal in Boston for a client who had sold a Lamborghini Countach, They had bought it. Actually, it was the exact same car that was in this movie called something with High Times or Fast Times movie. I forget the whole name. They had bought the car for $85,000 and sold it for 1.5 million about a decade later, and we were able to help them avoid capital gains taxes on that. Um, people have various collectibles, baseball cards, all types of transactions I've been involved in. So as we kind of go down the list of the remainder of the 12 strategies, you can see the attributes. But one of the critical things that becomes or that is becoming more and more prevalent that our clients are asking about is how to shelter their net worth and all their assets from not only the third party creditors, but also from ex-spouses or perhaps soon to be ex-spouses. So there's a lot of divorce protection components built into this planning where we don't want to just, save you a bunch of money from the IRS and then have it be taken away in a divorce or a lawsuit situation. So here's a summary of what those benefits look like when we do these particular 12 capital gains tax strategies. So again, it's all about leveraging your tax rescued dollars. And by leveraging those tax rescued dollars, you are able to take advantage of redirecting those dollars into various other aspects and various other transactions that are more important to you. So here's a quick little snapshot of transactions that we have done over the years. One was a sale of a piece of real estate in New Jersey. The other one was a sale of business plus real estate. This was in Seattle. It was a $45 million transaction. We were able to save them $10.8 million. Then this is a very interesting, husband and wife dentist out of Omaha. And they had 145 Bitcoin that they were selling. And once again, we were able to save them the taxes. We had an IRA liquidation case just about 3 years ago, I believe. Very, very successful guy out of Los Angeles. We were able to liquidate his IRA with zero capital, with zero income tax liability, with zero ordinary income tax. And as a test, I got to tell you, I posed this to my new prospective clients and to their CPAs. And I said, look, if my client has an IRA and they would like to liquidate it, can you do it without paying income taxes? And as many years as I've been asking this question, the answer is always no from the CPAs, but yet we do it on a regular basis. It's very interesting. This last example is also very, very cool. That's why I put it in here. This is a gentleman, his name is Gary, out of Louisiana, very high-level engineer for Chevron Corporation, base income $1.5 million, W-2. He had a deferred comp problem of $6 million. And, his son is also a hedge fund manager. I'm also a fund manager. And we were sitting at a conference and he said, hey, can you help out my dad? He has a $6 million payday coming up. And we have gone to KPMG, who's their corporate accountants. And Morgan Stanley is their financial advisor, and nobody can help. And once again, we were able to show them some very conservative, but little known advanced strategies to help them save $2.7 million on the deferred comp, which is essentially ordinary income tax. So all of us have been trained to essentially work all our lives, 18 to 65 years, pay our taxes, raise the family on whatever discretionary income we have left. And then if there's a couple of bucks left, you save for retirement and hope for the best. And then when you do retire, your advisor at any, I don't care if it's a financial planning firm or a stock brokerage firm, they would say, hey, Mr. Client, please do not take more than a 4% withdrawal on your life savings because you may risk running out of money if you're expected to live to age 80 or 100 or 120, and now you live in fear your entire retirement after having paid your dues for 40, 50, 60 years of hard work. So we would like to turn that model on its head. And this is our new paradigm that I'd like to introduce you to, where utilizing some of the tax strategies that I've shared with you this afternoon, if you were to contribute 100% of your earned income, doesn't matter if it's W-2, 1099, K-1, within a very short period of time, anywhere from a month up to maybe 12 months on the short side, we can essentially equal or balance out the dividend income that's coming from the tax saved dollars and have it match your earned income. So we capture all the income tax savings right at the top, put it into these tax favored tax strategies, generate high enough dividend income so your monthly bills are paid, so you start living off of it. And the minute that number matches, you can literally retire from that particular job or continue working. And now your monthly income just simply every month, it just goes up by that percentage point. And then utilize those dollars to do, to prepare a 1,000-year legacy or a 10 generation legacy, each generation being 100 years old. And then the balance of the tax rescue dollars you can put and build into your own community. May it be within the US, may it be within your local neighborhood, or if you're an immigrant like myself, it could be in another country. And you can take those tax rescue dollars and build and help the greater mankind and greater humanity from that. So expanding on that, as we are talking about, the fantastic job that Bluestone Investors Group does for all of its investors, this is the way it would look for someone like you. The monies get captured into the bubble, depending if you're a W-2 earner, 1099 K-1. Those are two separate types of, individuals in our book. We capture the income tax savings right at the top. And this is a three-step process that we would follow. So after we have captured the income tax deductions, we then open and fund a brokerage account at Equity Trust Company. Then BD, in this case, he's the fund manager, the monies get deployed into the real estate deal to generate what we call an extrinsic yield, because intrinsically was the income tax savings or the capital gains tax savings, which could be 30, 40, 50% for some of you. And then the extrinsic yield is what Bluestone generates for you. So if you were in a 40% bracket and BD, let's say on the low side, generated a 10% return, you are already at a 40% IRR into your particular investment. The equity trust basically wires the funds to the fund manager. The fund manager receives the funds, deploys the strategy, and then when a yield is generated, may it be on a monthly cash flow from rental income, or may it be at the disposition of the asset, those dollars flow back into the equity trust brokerage account, which is your account. And now when you take distribution from it, the distribution is also tax-free as long as we comply with what IRS calls HEMS, which stands for health, education, maintenance, and support. Now, the S is the most important out of all of that, which is the support part, because everybody's lifestyle is different, everybody's way of living, what they drive, where they live, what they eat, what they wear. So the support is really where majority of the flexibility lies, and you can essentially live your life within those four letters. And by complying with those four letters, again, health, education, maintenance, and support, and have a non-taxable event at distribution. In addition to the income tax and capital gains tax and estate tax avoidance that we've been talking about, we also like to offer you these additional 16 services, which is, of course, the income tax mitigation, the consolidated reporting, concierge medicine. There's all these services that are listed on your screen. These are also included. The consultancy on that is at no cost to you, especially the tax-free business succession planning, like I was telling BD before we started the presentation, over the last 2 years, we have helped one company actually out of San Francisco do a $400 million exit at zero capital gains tax. They had about 8 partners. And then another company for similar $400 million exit out of Salt Lake City, Utah. And they were just amazed how entrenched we are into advanced tax planning strategies. So for those of you who are 1099 and K1 earners, we do have until October 15th of this year to get you a full tax refund on your 2023 taxes that you may have already paid. And if you are on extension, then we can help you avoid having to get stuck with those taxes. A lot of the times people ask us, well, why do CPAs and tax attorneys don't know what your firm knows, Zach, or what you know personally? And it simply reminds me of a hamburger factory, right? All of these colleges and universities, law firms, they all are essentially cookie cutters of each other. So you can go from to a local accountant or an attorney, or to somebody in the middle of San Francisco. The only difference that I have found over the years is in their cost and their price, and that really is driven from their location, not so much from their knowledge, because their knowledge is exactly the same. So in other words, you cannot get a steak from a hamburger factory.